All right, everybody. Welcome back to the Crypto 101 podcast. I'm your host, Bryce, back in the saddle after an extended paternity leave. Brendan, how you doing, man? It's good to be back.
I was about to say, it's good to have you back. There's been, man, what a wild ride it's been since you left. We're going to have to limit you from leaving moving forward because the state of crypto just couldn't handle it, Bryce. But no, good to be back. I mean, you're coming back on an absolute banger of a podcast too, because we get to talk to some leaders in the space about probably one of our favorite topics. Maybe we're a little bit biased, but tokenization and real world assets. We're back here to talk about it again. The supposed potential multi-trillion dollar industry that is coming towards the future. And we like to talk about it.
Yeah, and I know I'm already going to be breaking one of Jim's rules here by saying RWAs, real world assets. I know it's a term he hates because he comes from the financial world where RWAs means risk weighted assets, and real world assets is just a stopgap of a term. But anyhow, we're going to introduce our guests here. This is Superstate. They've been on the show a couple times. Jim Hiltner, who's a co-founder of Superstate and the head of business development, as well as Fig Gowen, who is the head of protocol relations. Gentlemen, how are we doing?
We're doing quite well. I got a little bit of sleep last week while I was traveling. Not, probably dissimilar to what your nightlife has been like for the last couple of weeks, but good to see you bright-eyed and bushy-tailed this morning. And excited to be back on. Appreciate you guys having us back here. I know Brendan was shouldering quite the load, so excited to give him a little bit of breathing room today and be back on the show. And thanks again.
You bet. How's it going, Fig?
Guys, happy to be here. I think I need a microphone like that, but good to be here and looking forward to it.
No, you sound pretty good. Everybody had their coffee. Everybody got their stimulants of choice. Maybe a little Zyn going on, whatever it is. I'm sipping out of my mom cup because all of my dad cups are dirty. But that's just dad life. So
it's hard to do dishes and change diapers at the same time. So we get it.
Yeah. Well, let's just by way of introduction. As we said, we've had Jim on the podcast before, and we'll link to those prior episodes as well as with Alex Zozos, who's your head of legal. We'll link to those in the show notes. But just for those who are busy, they can't go back and watch. Quick introduction, and I really do want to just kind of frame this. Jim, for you, what made you switch over from the traditional markets to the decentralized markets?
Yeah, so I spent the first decade of my career in traditional finance and have moved my way into crypto over the last 3 or 4 years full time. I was constantly moving away from like the back office into trading, and then from trading into fintech and fintech into crypto, and just like trying to stay out ahead of the innovation curve that's coming to capital markets and building all of it at the same time, not just watching things on the sidelines, but actually actively participating in, how we can actually uplift the traditional ecosystem into what we think is a much better way to facilitate capital markets across a number of different asset classes. And, was very fortunate to join Compound and had a first person view of, how DeFi really operates, working at the protocol, both on the protocol side as well as on the institutional side. And, we decided to, take a bigger swing at the, increasing the utility of financial assets by launching Superstate. And we're, here a year and a half into our journey and got a lot of stuff happening and a lot more work to be done. But yeah, it's always been a theme of mine is to, stay innovative and not just, kind of like take the status quo for what it is. And, Superstate is definitely blazing a new path, and excited to talk about all that we have done thus far, and more so focused on kind of what we see in terms of opportunities in the future and how we're seeing the landscape change on a minute by minute, day by day basis.
Yeah, awesome. I love it. And Fig, Mr. Fig Gowen, you've got a deep background in DeFi and the crypto space as a whole, really a crypto native. I want to know a little bit about your background and kind of your pathway, since this is your first time on the podcast. And along those same lines, kind of how have you seen the space evolve?
Yeah, sure. So I started in crypto 2021, worked across multiple business types. First started at Voyager, working on the marketing team there From there, I got really deep into DeFi, doing HFT and trading and research at a fund out of Sydney, Australia. I was always really interested in the intersection of traditional finance and technology, and I think crypto is a great atmosphere for that. Started writing a lot about DeFi products and protocols, specifically like Uniswap, Aave, the big ones. Joined Aave on the grants team, got really involved in that ecosystem, just learning from developers and builders and contributors in that ecosystem. DYDX on their operations trust, helping them migrate and manage their trust as a trustee. Really fortunate to join Jim and Rob and some of the team here, and been mostly focused on our protocol efforts, working with crypto corporates, big DAOs, and foundations.
I love it.
Responding to your second question, like I have enjoyed seeing the space mature in terms of participants. I was always really focused on governance. I wanted to be a lobbyist when I was early. And I think governance is a version of crypto native lobbying, right? Like lobbying for very specific changes or proposals or initiatives. What's been really cool to see in the past year is people actually investing time and money into some of these initiatives and the changes that they're creating for a certain ecosystem. So that's been great to see, and I'm lucky to help contribute to that through Superstate.
Absolutely.
Yeah, I think it's one of the things that we identified early on as we were structuring the team. I come, as you mentioned, and we talked about a very traditional finance background and fintech, and very institutional focused on the asset management side, the bank side, the insurance side, you name it. While there's a lot of similarities between approaching and collaborating and working with the decentralized organizations out there, it takes a unique type of person with experience collaborating with those communities. Fig, as he just mentioned, brings a lot of that experience, but fusing what we do, on the enterprise business development side and, bringing some of the crypto native capabilities that Fig has brought to the table really arms us tremendously well to help uplift the asset allocation strategies that a lot of these DAOs are putting into place. It is definitely a different muscle, but underneath the hood, you're acting as a fiduciary for an operating entity that's trying to manage a balance sheet, working capital, continue to grow and fund for different initiatives and opportunities. And what's been really interesting to see is how institutional those processes are becoming. There's been a few landmark opportunities that we should dive into that are really creating a blueprint for other communities to follow that largely mirror what you see in traditional asset allocation practices. Real rigor on due diligence of counterparties and lining that up with investment objectives and having transparency and delivering on outcomes and constantly auditing and looking at different metrics to ensure that the capital that is there is handled the right way in order for these communities to continue to thrive. And diversification is super critical for that. As we saw, from the last cycle, if you're highly levered to the majors or your own governance token in a bull market, that feels all great. And you're constantly forecasting additional grants and opportunities and building out the team. But when you hit a bump in the road, like we did in the end of 22, you realize how much you're lacking in being able to sustainably operate that foundation or that protocol, and being able to turn that pain point into an opportunity is something that we're seeing happen across Arbitrum, across Sky, formerly known as Maker, across Athena, you name it. There's tons of different protocols that are now starting to wake up to how they should be managing as a fiduciary for their foundation and their community to extend their runway and to grow their balance sheet and have diversified uncorrelated yield or asset management capabilities that they don't necessarily have the infrastructure or expertise to do themselves, and so therefore outsourcing it is super critical. We feel like we're very well positioned to bring that, very strong traditional asset management under the hood, but also be extremely innovative in how you interact with these communities and not just deliver on the investment objectives, but also strategically align what you're doing to the goals of the community and create new products and new markets and new ideas that if you're working with a larger institution who doesn't have that type of crypto native expertise or really understand how these things operate, then you're lacking a big piece of the puzzle. And Superstate brings both of those worlds together. When I was at Compound, we ran a business called Compound Treasury, and a lot of folks thought that we were running the treasury of the Compound protocol. So it was a little bit of a misnomer. But what was interesting is spending a year or so in that seat, there was large asset managers who would approach me and say, hey, how can we help manage your treasury? And we saw that as a signal of the mismatch between service and, like the delivery on the asset management side and the needs on the asset allocation side. And so Superstate is set up to be the connective tissue between the two of those, and do it in the way that's highly compliant and highly rigorous. And that's what led us to launch Superstate and bring Fig in to really build and cultivate the relationships in these communities. And it's just been amazing to see the progression from random proposals that have been submitted to take assets from a protocol and help manage it, to really trying to define a proper process. And I tweeted a few weeks ago, which I think is something that the institutional community will wake up to at some point, is you've got large pensions and endowments that run a very similar process, but the lack of transparency into the diligence and the RFP process and the asset allocation decisions that are made is something that I think the larger institutional TradFi community can learn from these protocols. Where if you look at the Maker Forum today, the Sky Forum today, they're running this Grand Prix, which we'll talk about in a minute. Yeah. But there's like 20 pages of information that we've submitted about how we're going to manage assets for the foundation that just doesn't exist in the traditional space. And I think that should be something that the institutional community will wake up to, and helping trillions of dollars of assets that are managed today be done in a much more transparent and rigorous way that today is very lacking and very opaque.
Yeah. And this is truly, this is an avalanche of new innovation, and it's not just on the tech side. Fig, as you mentioned, even just on the governmental regulation side, and you mentioned kind of, that sort of dream of one day wanting to become a lobbyist. And, I saw Fairshake, which is now the largest super PAC, is all dedicated to making crypto regulations and kind of bringing this to the masses. So you guys are really getting it on both ends. And, Jim, you alluded to, these two new products that you have, USTB and USCC. So we're going to dive into that. It's incredible, like kind of all the development that's going on, just like on the tech side, that finally it's there. These smart contracts are secure enough. You guys are able to get these, into different DAOs and stuff. And then simultaneously on the regulatory side, I even saw this morning there was a House hearing from the Financial Services Committee, and you had even the chief legal officer of the MakerDAO Foundation there speaking with senators, talking about how we should really regulate and kind of work with these DAOs. So it's pretty cool. It's pretty cool, all the development that's coming along.
Yeah, there truly is so much happening in the space right now, and it's easy for people to look at the crypto markets and be like, "Oh, it's choppy." Like, what could really be happening? But there's actually just so much going on. So, Fig, from the protocol and DAO level, fast forward to the current day. Can you catch us up on what you have been working on Superstate since we last had the conversation with you all?
Yeah, definitely. I think there's like three core really exciting opportunities for DAOs and protocols right now. The first one, which has been a model for the rest, has been Arbitrum's STEP program. STEP is Stable Treasury Endowment Program. They earmarked at the time $50 million, which was 1% of their treasury, to be invested into stable yielding products. So that was an amazing opportunity. They probably received 20 to 30 applicants. And in the end, they chose, I think it was 7. Superstate was very fortunate to be chosen at the second largest allocation, about 17% of that program. And that was awesome. They had every single question about, where you were incorporated, your product and the underlying security, the team, the experience working with these sorts of protocols and ecosystems. From there, one that we're really excited to be considered for and actively working on is Athena's Reserve Fund and their USDT collateral.
Nice.
As you know, Athena is a basis trade product. They're looking for more capital efficiency and yield and liquidity. And they've asked for different providers to come in and submit their products. We recently applied USTB to that program and hoping to hear more soon. That's really interesting for them because they earn yield for their reserve funds. When funding rates go negative, they have more insurance, more flexibility through these products. And then I think what Jim and we have all spoken about so far is MakerDAO, or now Sky, has announced $1 billion tokenization Grand Prix. And that name is really exciting. Anybody who's building in tokenization is reading about this program and saying, how can I get involved? Mm-hmm. So the program is led by a team called Steakhouse Financial. They're sort of a financial advisory firm, which was born out of the old MakerDAO days. And it's been operating through the Spark sub-DAO. So Sky now has stars, which are these, sub-organizations focused on certain initiatives or products. And Spark has been designated as the first star to focus on RWAs. And the biggest, why this matters is $1 billion to back the reserves of their stablecoin products. Mm. So MakerDAO previously had DAI, and now they've got USDS. And USDS is a new product, a new stablecoin product, which is going to be mostly backed by short-term tokenized treasury bills. Enter USTB. So we were very fortunate to post our application last week or 2 weeks ago now. It's 26 pages. It's incredibly rigorous. It tells you everything about our team, everything about the product. And it's a really exciting opportunity for anybody building in this space.
Wow. And so basically, if I understand it correctly, MakerDAO is this kind of credit facility. They issue USDS based on some kind of collateral, and y'all are proposing for USTB as well as USCC to be that collateral that some of these stable coins are kind of issued against. Is that right?
Yeah. So we're only proposing USTB. Okay. They've identified a need for short-term U.S. Treasury bills. That's what USTB is. It's a great fit. And they've identified 2 objectives. One is liquidity, right? They want to be able to balance the peg, sell these assets, invest these assets quickly and on a daily basis.
Nice.
And then 2 is yield. They want to earn yield on these reserves and from this collateral and give users more capital efficiency. So we think USTB is positioned well for both of these. We've got low fees, which leads to high yield, and then daily liquidity when redeeming before 9 p.m.
Awesome.
9 a.m., excuse me.
I've seen people have a mixed reaction to some of the stuff that Maker has been doing. And I think it kind of fits into this conversation about just blockchain-based assets and funds or stable coins being backed by traditional sources, like U.S. securities and treasuries and bonds and things like that. Do you guys see a problem with that? Because it's hard, really, it really is. It's a difficult conversation because when you look at the U.S. and the stability that a lot of those assets bring, they are the largest, they are the leaders.
Yeah, and Brendan, I know you didn't ask me, but I'm going to answer my question, that answer first, because I think a lot of this hate is misguided. Because Tether is already backed by securities, and they already have a freeze function, right, on Tether. And so I think people are saying, oh, like Maker, sold out, but the main and the same thing happens with USDC. And so it's like all of the stable coins have a freeze function, and all of them are kind of backed by kind of short-term debt or securities. And so I personally think some of the shade is misguided.
I would agree. And I think that it arguably makes the coins more reliable and more stable and slightly even more secure by backing them by this. And so I think it gives it a sense of strength almost. And I don't think it's as bad as it has been put out to be online.
I mean, I think it's attractive for the government. You know, we now have more buyers of government debt, and crypto is contributing something to the United States and the security and the stability of their currency. I think that's really exciting to see more products, you know, integrate with traditional finance and some of these traditional securities. And it's happening already, as you guys say.
But the beauty of DeFi is you have access and choice to invest in or participate in different products depending on your risk appetite or your general philosophy. And so we talked about two different products here. You look at Athena, USDE, and they're running a synthetic dollar based off of a peg with the basis trade behind it. That is a $3 billion market cap stablecoin, right? That they're not calling a stablecoin, it's a synthetic dollar that has collateral behind it that's very crypto native, and it's touching CeFi with a bunch of different positions. And that is a really interesting product that clearly has a ton of demand. It's a really, really cool product. Then on the other end of the spectrum, or like I guess kind of halfway in there, you have what we're talking about with Maker. And so yeah, like they're looking to back a lot of the USDS with, you know, highly liquid, stable treasury bills because, you know, they're the best asset on the planet to do so. And there's a potential revenue opportunity and incentives and whatnot that exists because the yield in, you know, Fed funds rate is still really attractive. And our philosophy is, or our thought is, and I'm not an economist, is that it will continue to be very attractive. And then all the way on the other end of the spectrum, you know, you've got Circle and you've got some of these more centralized stablecoins like PYUSD that, like, while they still have a lot of, you know, open access and composability across DeFi, they're backed by, you know, a trust account that's holding a bunch of treasury bills. So, you know, while there is maybe some philosophical differences between all three of these, the beauty of DeFi and the, you know, structure of these products is that as an investor, as a user, I get to choose whether I want to hold, you know, 100% of my balance in USDC or PYUSD or USDS or USDE. And that to me is a great spectrum. And it's a baseline too. Like these markets, to your point, like there's a lot of building going on. And, you know, STEP was named the way it was because it's step one of a process for Arbitrum to diversify their treasury. I think the tokenization Grand Prix is step one of N steps for them to continue to build the most resilient, amazing protocol for investors to have a highly liquid, highly stable product that enables them to do things on chain that you can't do with regular dollars, that give you the type of resiliency from a, you know, underwriting standpoint, but also a lot of utility on the product standpoint. And how you decide to back that is something that governance will continue to have to debate. But I think, you know, starting with treasury bills and looking at the models that like Tether and USDC have, which clearly have the largest market share by a magnitude of, you know, multiples and multiples, is a really good strategy for Sky to start with. But I don't think that this is the end game for them. This is definitely the first step, and will continue to evolve. And maybe there's other offshoots of other products that have a different flavor of structure and collateral backing that give investors the choice to diversify their assets in ways that they feel the most comfortable or most philosophically aligned.
Yeah.
And just to jump in quickly, I think Sky has realized this.
Yeah.
You know, they've identified a path forward for two stablecoins, USDS, which is going to take over the RWA aspect and the RWA reserves, and Pure DAI, which you can update from DAI. So I think they're catering to both types of choices and both types of users, and that's a really interesting strategy for this sort of ecosystem.
And just a question on that. So would Pure DAI kind of almost be like the original DAI? I think it was S DAI, like kind of single collateral backed, just basically just a dollar backed by 150% of Ethereum?
Yeah, exactly. Crypto collateral. And one thing Rune, who was the co-founder of Maker and now Sky, has sort of admitted is there's a chance that this may not maintain its peg because of the underlying collateral. Whereas USDS is backed by treasury bills. There's a bit more stability. But as a consequence, there's also a freeze function. So there's a bit more compliance, there's a bit more restriction on that sort of product.
Yeah, well, I think you all said it really good in the sense that because of the way that this market works, because of blockchain tech, we're able to pick which option we want. And there's always going to be more models. And that's the cool thing about this, is that we get to cater to the best side of both worlds here. And I do think the side that dips and favors TradFi is still a very important one, because we're not at a perfect world scenario yet where blockchain is completely globally adopted and accepted and everyone's using it for everything. We're just not quite there yet. And until we get to that point, we need to be able to communicate and cooperate with TradFi. I mean, I
don't think I want to even live in a world without a government, really. I'm not in the anarchy sort of school of thought. I think a world without sort of this organized government, it could get pretty ugly pretty quickly. So sorry to interject, but yeah, you're totally right.
No, I mean,
it's a new father speaking. I totally understand.
Basically, there's a place for both sides. There's a place for TradFi and there's a place for DeFi. And it's not like it has to be this all or nothing scenario. And hence why we're seeing essentially two different versions of stable coins here. So I think having the option to use either one is a really cool thing. And also, this just shows that the industry is maturing, just going through this and being able to partner with TradFi and create these things in the first place. But, do you both think that maybe the introduction of similar tokenized funds from TradFi, such as the BUIDL fund, for example, are a net positive for the crypto space?
1,000%. Emphatically, yes. And, I think it's not a binary outcome as to where this market heads. I mean, we all want trillions of dollars to be traded and used and issued on chain. And in order to get the largest institutions comfortable to be able to deploy capital, they need the type of rigor and counterparty structuring that a superstate fund brings to the table that makes them feel comfortable going to legal and compliance and risk and operations and saying, hey, when I put $1 billion of capital at risk on chain, here's how I'm doing it and here's how I've underwritten that. Now, not everybody is going to feel like they need that type of institutional framework to allow them to deploy capital. So there will be, a tremendous amount of value and assets that are deployed into more crypto native, more, I don't want to say risky, but they're less institutional products. And that's not a negative thing. That is just, an option. And the beauty of having a product like USTB is that it brings the best of both worlds together. It has a very unique way for investors to interact with traditional funds and bring traditional securities into these protocols that can then be used as collateral. They can be moving around at the speed of the internet. And, there's a lot of really great things that happen with that, but that doesn't necessarily mean everybody is going to want to have that as their, peg stability module behind the scenes. But you're seeing a diversity of things come on chain. And I think BUIDL has really proven, by BlackRock leaning into tokenizing some of their products, they'll continue to issue more of their products on chain. And, part of that is because they want to cater to, their existing investor base that are looking for more interesting and more efficient ways to interact with the ETFs or the private funds or, whatever other products that BlackRock offers to them so that they have more liquidity or more 24/7 markets or better transparency or more utility around those. But then there's another side of the audience, which are, looking for more crypto native products that, have Bitcoin and Ethereum and Uniswap and all these other assets that are, really interesting on the crypto native rails that can also be brought into traditional products as well. So I think it's great to see them doing things on both sides of the coin. I give Franklin Templeton a lot of credit too, because they're also doing the same thing. So yeah, I think it's an amazing progression in the industry. And if you look at the growth in tokenized treasury bills over the last year or so, there's $2 billion sitting in that, which is a infinitesimally small number. I know you say wow, but it's actually tiny compared to the $6 trillion that's sitting in money market funds today. And BlackRock is building for the $6 trillion number. and not the $2 trillion total market cap that is crypto today. So there's an unbelievable amount of opportunity to be unlocked, and that's what Superstate is building towards, is trying to figure out a way to fuse these two worlds together to not have it be DeFi or TradFi, but just have it be finance. And it used to be, oh, I have electronic trading, or I had paper-based trading. It's like trading is just trading now, and like that's all because it's been upgraded into a better system. That's what we see is happening with tokenization.
Yeah, and I want to ask, maybe either of you could take a crack at this one. And I know you guys each spent a lot of time talking about it in different capacities, but moving even beyond the first step, right, which is tokenizing these short-term treasury bills. There's a lot of ideation out there around tokenizing real estate, or tokenizing. I've seen tokenizing diamonds and tokenizing all these different kind of things. What do you think is kind of that next step in terms of asset tokenization, particularly in regards to Fig? Like, what would a DAO find most useful to have tokenized?
Yeah, so I'm curious to hear Jim's opinion. One thing I just want to say is, like, to give you a picture on the tokenization market, right? There's $2 billion in tokenized T-bills. There's about $8 billion in private credit. That's the largest sector of tokenized assets. Commodities is less than $1 billion. And you've got $170 billion in stablecoin, which in my opinion is a tokenized asset. We could debate that. That's another podcast, which may be interesting. In terms of DAOs and their appetite, I think they're looking for stable, predictable returns. I think Treasury bills was a great start at that. I think it'd be great to give them exposure and an opportunity at other asset classes, which historically are unavailable on chain. These are equities. This is real estate. I think commodities with gold and how hot that is, it's really cool. People forget like products like PAX-G. And I'm curious to hear you guys' opinion. I don't think there's a right answer, but there's definitely going to be more coming into this space.
Yeah. I'll give you like firsthand experience for us, like not only on the DAO side, but all the investors that we have at Superstate and we have relationships with have been asking for, treasury bills fits a part of their asset allocation strategy, because, I've got bills to pay in the next year. So I want highly liquid, high yield products to enable me to extend my balance sheet for the next 6, 12, 18 months. But when I look out further and I want to go 2 years, 5 years, 10 years, there's longer duration assets potentially that I could invest in that have yield component towards it that's predictable against it's ALM, it's asset liability management. And so there's a large progression that we foresee happening from the T-bill side, which is like the bottom left corner of the efficient frontier, and like working your way up to more higher yield, maybe longer duration type of assets. But what we heard very emphatically from our clients was that they still wanted liquidity. So while we wanted to satisfy both yield and liquidity, we created USCC, which is our crypto carry fund. And what that does is it takes the basis trade that we talked about earlier that Athena's doing, but wrapping it in a fund that, again, big institutions feel comfortable investing in because of the counterparty structure and rigor that we built on that product. And it provides a higher yield exposure, yet we still maintain daily liquidity in that product. So you look at our treasury bill fund is yielding 5.33%. That's Fed funds rate. That's pretty plain vanilla. That's, again, satisfies a pretty decent size of most financial players' appetite. And then our crypto carry fund that has the same amount of liquidity is yielding like 11 or 12%. And that's because the strategy underneath the hood is allocating not to treasury bills, but it's allocating to the basis trade. And the basis trade, for those that are not familiar with it, is not a crypto specific thing. But in crypto, what it means is you're basically going long spot and short futures or forwards or perps against the spot crypto. And because of the difference between the price of the spot, maybe it's $50,000 for Bitcoin, and the price of the future or the forward or the perp, you have this spread that allows you to generate a predictable yield from when you put the position on until you take it off. Now, there is a large, again, going back to the liquidity, folks still, while they're still pretty nascent, like these are new organizations, like the ALM forecasting is really, really difficult when you've only been around for like a year or two and you really started to think about what are our operations going to look like in 5 years if you're a DAO. That's kind of hard to forecast. So what we brought to market with USCC is the best of both worlds. Like you could still get higher yield and maybe you hold on to that position longer, but still if you need access to it because you didn't forecast properly, you can redeem from that fund and get your $1 million out and pay for a grant or developers or whatever it is for you to continue to manage your operations. So that's where we see in terms of how we've approached the market in terms of going from treasury bills into crypto carry fund. What happens next after that will continue to progress up that curve, hopefully continue to maintain liquidity as we feel like that's still very much needed, but yield is, obviously the number one priority for a lot of these counterparties or investors in our funds. And, in the future, as these systems mature where you have robust secondary markets and a ton of liquidity where these assets are moving around, that's when you can start to bring things like real estate or private equity or things like that on chain that help you, upgrade what they are doing in the traditional system and give access to these types of products that like crypto native investors don't have access to today, or even traditional investors don't have access to, but could if it was tokenized and the distribution of that product was much more efficient for them to get access to than in the traditional world.
Yeah, and I guess even outside of DAOs and protocols, do you think that individuals are going to be able to interact with tokenized products?
Yeah, I mean, so when we first launched Superstate, our 6 months, after launching the business, we put out a prospectus to the SEC because ultimately the way that our funds are structured right now is that they're private funds, and we are only allowed to permit qualified purchasers in those funds, just given the structure that we have, which I'm sure Zozos went into a lot when you guys had him on the podcast the last time. Yeah. So I'll let him bore everybody if you go back and listen to that. That's, he'll give you the reasons why that is the case. But ultimately, the goal is to continue to work with the SEC and say, hey, what we're doing in these products looks very similar to traditional instruments. When you were concerned about allowing a mutual fund to convert to an ETF, and now ETFs total AUM is larger than traditional mutual funds, we see the same thing happening on the blockchain side, where like underneath the hood, it's a money market fund, but it just has a token that represents shares that allows you to move these assets around in a way that when you had a mutual fund, you could only go in and out with the issuer of that fund on a daily basis. With an ETF, you now have this like really sophisticated create redeem process that allows for 9 to 5, Monday through Friday, just like a stock trades, to move in and out of a passive index fund or an actively managed ETF. That progression will then move to 24/7 as you get to a blockchain-based system where you can still record ownership and allow investors to move in and out of different products, but doing that facilitated on chain because the legacy capital market systems is just not equipped to be able to facilitate that type of activity. And so in order for retail to get access to these, to answer your question, Brendan, it's going to take a regulatory regime that permits these types of products to be listed as 40 Act securities or other types of securities. Maybe they even need a different type of structure. But our view is that the existing regulatory system should be able to accommodate for these types of products because what we're doing right now is we're preventing investors to invest in USTB or USCC that should be getting that exposure because they're not a high net worth individual or a large institution, but all the disclosures and visibility and strategy of where those assets are being deployed is the same as traditional products. It's just given the regulatory regime that we're in right now, we're prohibited from allowing retail investors to participate. But I guarantee you, as soon as we are able to do so, they'll flood into these types of products because they love this technology and they love this exposure. They're just they're not able to participate right now.
And I guess even from like a time perspective, how long do you think that will be? Because I think a lot of listeners, when they think of tokenization, they immediately go to probably the most relatable big assets. They think, oh, I'm going to be able to tokenize illiquid things like real estate or like my car or art, or, we've seen artists doing this and things like that. But it almost seems like we're going to see tokenization regulation and approval on things like this first, where it's, bonds and other things.
It could be as soon as this November 5th or in 4 years, November 5th.
Yeah, I mean, unfortunately, it is politically driven on potentially where things will head, but I think that is a factor. To be honest with you, and I think this will surprise a lot of your listeners, is that when we submitted our prospectus to the SEC, we anticipated a big red no written across the page with no feedback aside from that. And to give them a ton of credit, like the staffers that were reviewing that application came back with 20 pages of really, really thoughtful analysis and questions and objections. Like, we haven't gotten it approved yet. Like, so obviously there's still things to work through. But I think the broader commission is looking at these things in great detail. And I think, going back to your earlier question, like having BlackRock and Franklin Templeton throw their hat in the ring and say, we want these things to work. How can we make this happen and collaborate with you to do so? That will continue to progress regardless if it's blue or red in November. And maybe the tailwinds will be there, the headwinds will be there, depending on how things go with the election. But I think the underneath the surface, there's actually is a lot of progress that folks don't really give the environment a lot of credit for. And these things take time. So is it 6 months away? Probably not. Is it a year away? Maybe. Is it 2 years away? Probably. And so that's kind of our view, and we're playing the long-term game to make sure that these all continue to move in the right direction. But to Bryce's point, the fact that the House Financial Services Committee is hosting a session this morning with a bunch of top DeFi leaders, they're now getting super educated about how these markets actually operate from real experts. And some contrarian thoughts as well. I'm sure that it's not all roses and rainbows. I haven't listened into it today, but there is a education that is required. And I've worked with institutions my entire career. It's the same thing as you're trying to sell a new product to them. You're selling a new product to regulators, and they're just going to have to do their homework before they really get comfortable. And once the watershed moment happens, it's going to be gangbusters. And you've seen the growth charts of ETFs. Like, these things were approved in the 90s, and it's been a hockey stick growth. And now we're in 2024. If you look at 2040, 2050, you're going to look back and say, wow, the same thing happened, maybe at an even more exponential pace once these things get approved, just because of the sheer utility and benefits that tokenized versions of assets bring to society.
Yeah, I love that answer. It's incredible. And that kind of even answered one of our closing questions, which is kind of, what does this world look like in, 5 or 10 years? But we'll get there in just a sec. Because Fig, I got a kind of question for you. Right now rates, kind of globally are pretty high, but we're recording this, the FOMC meets today, I believe, and they're going to talk about their decision on rate cuts. Or keeping things stable. And I think a lot of the world is starting to price in lower yields. And it wasn't so long ago. It was, I think, late 2021, early 2022. We even had negative real yields on treasury inflation protected securities and different things like that. And so I'm curious, how do you think, USTB, let's just, we'll start there. How does a product like this maintain demand with the DAOs and the protocols in a world where we have declining or even maybe back to zero interest rates?
Yeah, it's a great question. I think we're really fortunate here at Superstate to offer a really competitive product in terms of fees. And I think people are going to become a lot more fee sensitive because of these rate cuts. We're actually seeing a lot of, influx into these money market funds, and it doesn't really happen. Like, outflows don't seem to happen until to the second or third rate cut. I've been really interested, looking at some of the jobs reports and JOLTS and trying to think about how these rates change and how quickly. But there still seems to be demand. And what's really interesting to look at is DeFi rates as well. So if you're looking at on-chain rates for USDC or on Aave or Compound, they're around 2%. Now, historically, 3 months ago, 4 months ago, they were 7%. But right now, these yields from real assets, from traditional assets and securities, are much more attractive than some of the offerings in crypto or DeFi.
Yeah, so, I think even if the Fed cuts rates, they're not going to cut rates to zero anytime soon, if ever. Just look at the fiscal situation, and I don't think any of us on this podcast are economists, so take this with a grain of salt. But there's a serious need for the Treasury to continue to issue debt across the curve, but mostly at the front end of the curve, which attracts investors to that. And if you look at what's happening in Japan and China and other regions, they're continuing to look at other sources of yield. Whereas historically, they were just parking all their money at the treasury, and we were paying them a decent rate because it wasn't competitive in their sovereigns. That's changing, and I think just given some of the with what's happened with the sanctions in Russia and whatnot, like there's folks that are trying to figure out like how do we deploy capital so that we're continue to like manage our balance sheet and not be completely exposed. But in order to attract capital here to the U.S., in order to fund the just structural deficits that we have in this country, I don't think rates are going to go back to a 2 handle anytime soon. And even if they do, to Fig's point, like there's an opportunity cost. If you're looking at deploying capital into an Aave or compound, those rates are pretty volatile, and like they might be structurally higher than treasury bills for a year, 2 years, 5 years, who knows? But there is also a lot of volatility in that, and there's more predictability in treasury bills. So folks are going to make their own decisions on how they want to allocate capital, but I don't think it's going to go back to like treasury bills are at 0 and Aave compounds at 9 or 10%. Anytime soon. So we don't really foresee this being a major issue. And, I think folks, especially that are more conservative, that are looking to fund their business, they don't even care if it's, a 3% or 4%. They'll take that all day versus just holding stables where they're getting 0.
Mm-hmm. Yeah. I mean, you really nailed it. And I think I stand corrected. I don't think the FOMC is just this week. I think it's next week. But still,
I Googled it when you said that. I was like, shit, I should have known if that was today, but it's not.
I did too. Well, no, gentlemen, this was awesome. And I definitely, want to make sure that we got all of what you think the audience should know. Did we answer all those questions? Was there anything that we maybe left on the table that we didn't touch on? Any exciting developments coming up, or, big integrations? Anything we didn't touch on that we really should have?
Yeah, the integrations piece is actually super interesting, and I'll punt most of this over to Fig. But when you have a tokenized asset, like we've been talking about this, you can tokenize anything. Like I think what Galaxy tokenized a violin, which is really cool as a proof of concept. Yeah. Like I think founder of Animoca had a violin, wanted to use it as collateral, so they tokenized it, brought it on chain, which is really cool. Like a proof of concept that will hopefully create a business model for a bunch of other assets to come on chain. But the reason why that's kind of interesting, or what we're seeing is as interesting, is when you tokenize things, it's not just because I have a token and it sits in my MetaMask or it sits in my Anchorage or in my Coinbase wallet. It's like I can actually do something with this. I can move it 24/7. I can post it as collateral. I can do things way more efficiently from like a collateral management or settlement standpoint that I just can't do in the traditional system. And so that to me is what is going to be unlocked with not just assets coming on chain, but the integrations that are now possible. Now, you have to respect underneath the hood the compliance constraints that you have as a regulated asset manager. And so some of the things that we're working on that we're super excited about are things like DeFi protocol integrations that enable clients to take the assets that they're holding and use them as collateral and swap them and do other interesting things. And so on the horizon for us is a very much dedicated focus on trying to build out some of those use cases so that it's not just, hey, I have a token, it's I can do more things with this, and that's why it is a token.
Yeah, totally. I love it. Brendan, any last questions that you got before I got one kind of random question that I'm just curious.
I was just thinking about how interesting the world is going to be when I have kids and what kind of tokenized assets my kids are going to be buying. I just imagine, I was kind of thinking of this, this idea that one day my kid's going to come home from school and be like, hey, Dad, I bought a tokenized, you fill in the blank. It's going to be like, oh, I bought a tokenized, car. I bought a tokenized Pokemon card. I bought a tokenized video game. And it's just, you giving the violin example really opened up my perspective on what can be tokenized and what really will be tokenized. And I think we really are just scratching the surface of it. So as funny as it may be saying, we tokenize these random things that we might not fully understand the value of at the current moment, I think in 10 years from now, maybe even less than that, we're going to look back at this conversation going, man, we were just barely scratching the surface of what is possible and how it's actively being used. And I think that's exciting. And I think it also backs this idea when we look at all these $1 trillion industry projections for the tokenized space, it really starts to make a lot more sense, because it's not like most other verticals where you're limited to just that industry. You look at finance, you look at gaming, you look at all these other things, they are fairly limited. But when you look at tokenization, it can be used and it can be a part of every vertical and all vertical, anything that's physical, it can be a part of and it can encompass. And I think that that's where the near endless potential of it is. So
I take it that the visit with your girlfriend's parents last weekend went well.
Oh, maybe too well. Maybe too well.
There you go. I love it.
Tokenized engagement rings.
Yeah, exactly. I don't think that'd go over well with her.
To go back to one thing you hit on there is, you can tokenize pretty much anything, but it's the why. And so like one of the things that we look at a lot is, like on the collateral side, you've got a lot of institutions that are posting buffers of capital with counterparties and requiring extra dead weight basically to sit there in order to support positions for the rest of their portfolio, because these things move on a T+1, T+2, T+5, whatever the like frequency might be. If you can do the same activity with a much more 24/7 immediate settlement and adjustment of margin and collateral, that then allows you to post less, which allows you to then do more. And so I think right now, like as efficient as the capital markets are, they're largely inefficient because of the amount of dead weight that's sitting around just parked in custodians and with counterparties supporting different positions, that if you could take a 20% haircut off of that or even more, then you could do 20% or more business, where as a asset manager, I am now no longer, and Bryce, you probably know this very well, running Tower 18, like you can then do more for your investors because you can deploy their capital in interesting opportunities that otherwise would have been parked as collateral with counterparties. So therefore, you're able to return more for your investors. And that just opens up an entire flywheel effect of how finance currently operates. With as good as it is today, it is still scratching the surface in terms of what it could be. And tokenization is really going to unlock a lot of that.
Yeah. No, speaking of Tower 18 and the Superstate Industry Council, you guys actually just rolled out round 2 of all of those industry participants. Quick note on that, Jim.
Yeah, super excited to see that continue to grow. Tower 18 is one of the founding members. So really excited to partner with you there. We now have 30 different members. We were able to bring on some very large institutions into the latest cohort. So go check it out. It's on our website or check our Twitter. But we're very excited to partner with that. We've been mobilizing that community a lot more to engage across the industry with regulators, with other counterparties, with TradFi, you name it. So very much early days on what that group is able to do. And we're very excited to continue to bring more members in that are bringing great ideas, great technology, new introductions and relationships and ideas that will continue to just foster the development and growth of the tokenization in capital markets.
Yeah, it's been awesome to be a part of it, and I never was in the Greek life as like a fraternity member in school, but this is like the closest I've felt to it. So I really appreciate being a part of it and the great culture that you're facilitating.
To be clear, on any prospective members out there, there's no hazing involved with this.
Dang it.
No. Hey, well, this is awesome. I just got one question, just because I'm curious, and I like to kind of get the opinion from some of the smartest people in the space. Outside of anything you're working on, maybe outside of anything you're kind of affiliated with, what's one company, what's one protocol that you think is really stand out right now? Doing something cutting edge, but maybe doesn't have anything to do with your direct business line. Fig, why don't we start with you?
I'm sort of cheating because it's indirectly related, but I like Figure Lending. They're doing a home equity line of credits, which are tokenized, built on the Provenance blockchain. There's also Figure, which is this new trading platform. So I think they're really cool. They've done a crazy amount of volume in line of credit already, and just excited to see them grow.
I got a brochure literally in the mail from Figure. Yeah, and it was about blockchain-based HELOCs, home equity line of credits. I was like, oh my God, this is the first mailer that I've ever got that says the word blockchain in it. So
it actually said blockchain in it?
It said blockchain. Swear to God.
Kidding.
Yeah.
they've done a good job of sort of scrubbing the mention.
This was 2 years ago, for what it's worth.
Yeah, so I think it's pretty hard to find reference to blockchain, but they're building on that and showing a real use case for something like that.
Love it. Jim?
Yeah, for me, I am not an expert in anything but what I do. And I would say what's been interesting to watch is the growth of DePIN and, AI and crossover with crypto. I know this has probably been talked about quite a bit with a lot of your experts that come on panels, but I am watching a lot of that from the sidelines and just really interested to see how these networks and the infrastructure around all of them that are underpinning some of these systems are being developed and incentivizing contributors and whatnot to these networks. It's a really novel and interesting way for what historically was done in silos to be, done much more open source and much more collaborative. And I'm excited to see kind of what that looks like in 5 years. As obviously AI is the buzzword of the moment and will continue to be, I think, just because of the impact it's going to have on society. But seeing the fact that blockchain-based networks and these types of systems can help facilitate the growth of that industry is really interesting.
Love it. No, couldn't have said it better. You guys have both been a true treat to have on the show, and I'm sure we'll have either yourselves or representatives from Superstate back on the show very soon. But that is all the time that we have allotted for today's episode. So if you guys want to find out more about Superstate, go to superstate.co, superstate.co, and you guys will be able to find all sorts of different links in the show notes to these fine gentlemen. Thank you so much for your time, and thank you for sharing all your insights with us today.
Thank you, Bryce. Thank you, Brendan. Appreciate it.
All right. Everybody, take care and come on back next week. We'll have some more great guests for you. Take care.